Hello, and welcome to another episode of the Market Snapshot series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today we are going to be having an interesting session as we focus on three central banks that are bound to announce their interest rate decision today. One of them has already made the decision, and the press conference after the decision has already started. So we will be looking at two more and try to understand that how the markets may react to the news. And once we go through this, hopefully everyone will have an advantage when they are approaching the markets because they will be doing so from an informed perspective. So hello, Toshians, and welcome to the session. Seeing I was late, I wasn't able to start the session on time. As usual, we normally do this at 11. But hopefully, if you're still around, you're going to benefit from something today. So apologies for that. Let's get things started. So I'll be starting with the economic calendar. And once we go through the economic calendar, then we'll got a couple of charts. And once we get the charts, hopefully we get to understand where we're headed. So I normally use the Forex Factory calendar, mainly because it has been the most stable website since I started trading. So the website has basically looked like this over the last 10 years. Nothing has changed much, and I think consistency is key. So yesterday, we had the FOMC press conference, and during the press conference, there was quite a number of takes after the Fed decided to hold interest rates level as expected at 5.50% being the upper limit on the US interest rates. So during the press conference, I made some short notes. So I'll try to find them and then we can go through them together. So I tried to summarize the statement. One of the key things that was highlighted is that the full effects of the current tightening cycle haven't been fully felt in the US economy. So we all know that central bank policies have a lagging effect. So if the central bank makes a decision today, then that decision will take some time before it's fully felt within the economy. And this can range between 1 year and 1.5 years. So this means that the last rate hikes that were implemented by the Fed to get to the 5.50% haven't been fully felt in the US economy, and that may explain why the Fed is holding rates higher for longer, but not hiking anymore to try and have the full effect of these rate hikes and hopefully get inflation dropping back to the 2% target level. So GDP is on track to hit 2.5% for the full year to 2023. And this is basically showing that the US economy is currently very resilient and very strong despite the rate hikes. So a lot of people are anticipating that the GDP would drop significantly and the US would get into a recession this year. But it was quite a big surprise that the GDP is on track to get to 2.5%. So high interest rates are weighing in heavily on businesses, fixed investment. So yes, a lot of businesses that make a lot of fixed asset investments, they normally do these on debt. And when interest rates are significantly high, then they are avoiding making these purchases. So it's quite a negative feature that the Fed has noted that is having an impact in the markets. And of course, before making any fixed investment, there's also the promising return from US treasuries. So while interest rates are high, the yields on bonds tends to be also significantly high. Instead of going for fixed asset investments, some businesses are just parking money in bonds, and this is quite a negative thing in the economy. So nominal wage growth is easing, and jobs have remained resilient with unemployment at 3.7%. So from the last NFP report, it showed that the US economy created 199K jobs, and this was higher than expected. Majorly, we know that some working groups had just resumed work after having some strikes, and this is referring to the United auto workers or UAW, as well as the Hollywood workers that were on strike a couple of months ago, but then they resumed last month, and this may have contributed to the high NFP number. So all the same, unemployment has dropped to 3.7%, and the labor gap is being filled majorly by immigrants. So low inflation readings are welcome, but there's a long way to go to get back to the 2% target. So the inflation report came in at 3.1%, meaning that the Fed is still 1.1% above the target, and they may have to hold rates higher for longer in order to achieve this goal. So the Fed Chair Jerome Powell kept repeating this statement over a couple of times during the press conference, and he basically said that we are strongly committed to return inflation towards the 2% objective. So if the economy continues as projected, the projected Fed funds rate is 4.6% by the end of 2024. So the Fed projects that it will cut rates next year, and it's hopefully looking to drop these rates to 4.6%. So the current rate is 5.5%, which is the upper limit, and the lower limit is 5.25%. So this means that the midpoint is somewhere around 5.375%. And this basically means that if it's 5.375 and it's bound to drop to 4.6%, then we would be seeing around 75 basis points drop in the next year, and that means around 3 rate cuts next year. So that's one key thing to consider as we look at how Jerome Powell responded to a couple of questions. So first question was majorly, are you done with rate hikes? And he said that we think we are there, but FOMC members didn't want to push the possibility of further rate hikes off the table. So if the economy changes trajectory, rate hikes could come. So the Fed is basically strongly opinionated that it has already achieved the maximum rate hikes and is now considering rate cuts as we head into next year. But then they have not completely shelved the idea of continuing the rate hikes, and this is dependent on the data that comes from the US economy. So if data comes in suggesting that the inflation is on the rise again, then in that case, the Fed may have to continue hiking rates. But then from the data we have been observing with the job market slowing down, then there's a good chance that the Fed may be headed for a rate cut, and the data is what investors are following. So in terms of rate cuts, he basically said that yes, we are discussing that possibility. Many Fed members are having that discussion and have expressed that in their Fed rate projections. So in every meeting, the FOMC members will deliver their projections individually, which the Fed Chair Jerome Powell will tally together and try to understand where the policy might be headed, and then they will use that later to make a decision on the following meetings. So on the question of recession, he said that yes, it is a very real possibility next year. And he also issued caution that it's never guaranteed to have a soft landing. So remember, in the history of these rate hiking cycles, it's only one central banker, Paul Volcker, that has ever achieved a soft landing in the US without driving the US into a tough recession. But then for Jerome Powell, he's not very confident that the economy might not get into a recession. So he said that that's a strong possibility and it's not guaranteed to have a soft landing. So on the issue of this happening amidst an election year, remember the US is doing its national elections on November next year. Powell basically said that we don't think about politics, we focus on the economy and what the economy needs. So we know that markets are forward-looking, and investors have been, over the last couple of weeks, trying to price in a rate cut by March next year. So one of the journalists asked Jerome Powell, since the markets are forward-looking and they try to price in or front-run the Fed, are you comfortable with the market pricing in a rate cut by March? So he said that we focus on what we have to do and the tools available to achieve our goals. It's important that the market aligns with our policy. So it basically shows that the Fed doesn't appreciate the market basically front running its decisions like it did before March last year, where a lot of market participants were basically speculating that the Fed would hike rates, and they went ahead and bought the dollar beforehand. And now that they're speculating that the Fed will cut rates, now they're going ahead and shorting the dollar beforehand. So it's not something that the Fed appreciates very much, but it has accepted that as reality. But then it also wants the market to align with the policy that the Fed is implementing. So the other question was, is below trend growth a precondition for rate cuts? So if the economy has robust growth, it may take longer before getting to the 2% target. So a strong US economy would be tough for implementing rate cuts. So he was being asked that if you're considering doing rate cuts at some point in next year, will there be a precondition of below trend growth? But then what we are seeing is a very strong US economic growth at almost 2.5% for the full year 2023. So if the economy remains strong and keeps growing at a faster pace, then it's very difficult to cut rates in such an environment. So this means that if the US economy remains very strong, then the Fed may have to hold rates higher for longer. But then if there's weakness in the economy and it starts flirting with a recession territory, then that would be classified as below trend growth. And in that case, the Fed could be cutting rates faster than anticipated. So he also mentioned that while inflation is coming down, price levels are not coming down. People are still experiencing high prices. Real wages are now growing faster than inflation. This is a relief to their budgets. So what Jerome Powell is saying is that since the events of 2020 COVID-19 are started, the large amount of money that was printed within the US economy, it basically caused a lot of inflation. And by inflation, I mean that consumer prices started going up in 2020. So they also kept going up in 2021, 2022, and now 2023. So the fact that the rate of inflation has slowed down to 3.1% and might actually get to 2% next year doesn't mean that prices are going down. So if you are buying a bottle of soda for, let's say, $5, that is before COVID, and the price has gone up, let's say, to $8, if inflation comes down in 2024, it won't go back to $5. So you're still paying a high price for that product. So if consumer prices remain significantly high, there's nothing the Fed can do about it. So people are still facing higher prices. But then he bargained that real wages are now growing faster than inflation. So the rate of wages increasing versus inflation has now been flipped, meaning that the rate of wage growth is higher than the rate of inflation, meaning that real wages are growing. So if the rate at which prices are increasing in the economy is slower than the rate at which wages are growing, it means that you have an advantage as a consumer. And if that situation is left as is for a couple of months or years down the line, then you are able to recover on the negative effect of higher prices. So that was the Powell's point when he was responding to that question. So he mentioned that the goal for the Fed is to bring in some more balance in the labor market without having a significant increase in unemployment. So we know that the labor market has been suffering as a result of both demand and supply. So a strong US economy requires a high labor participation rate and a higher number of people looking for jobs. But then the US economy did not have that, so they had to plug in more immigrants to take on those jobs. So Powell kept mentioning that immigrants have helped bring in some much needed balance in the US labor market. But then this has not had the full impact. So in this case, he's waiting a couple of more weeks or months down the line before calling the shot on rate cuts. So the other goal is growth slowing down without a significant increase in unemployment, and this would be characterized as a soft landing. So you want the US economic growth to slow down without taking a big hit on unemployment. And as a result, this would achieve a soft landing environment. And that would be the end of rate hikes and the start of rate cuts. So conditions for rate cuts was also a question from one of the journalists. So he basically mentioned that we are aware of the risk of keeping rates high for too long. So if you keep rates high for too long, it could bring negative consequences in the economy. So they want to cut as soon as possible, but then there are conditions for that. So you mentioned that we are looking at the aggregate demand in the economy, and we are looking forward to slower GDP growth next year. We are watching progress in inflation, and we are trying to avoid a large increase in inflation, and we are trying to avoid a large increase in unemployment, sorry. So how sticky is core inflation right now? He said that we have seen promising progress in core inflation. So goods and housing services prices are easing as expected. How much closer do you want to get to 2% before you start considering rate cuts? In this question, Jerome Powell basically avoided naming a number. So the question was that the current inflation is 3.1%. So if inflation keeps going down and gets closer to 2% target, at what point will the Fed consider cutting rates? So the Jerome Powell did not put a number, leaving the market second guessing itself at what point the Fed may go for rate cuts. So Jerome Powell also said that this inflation was not the classical case of overflowing demand. It was caused by unprecedented events that occurred during the pandemic, and this is majorly the large money printing that happened, or QE infinity. So far, so good. Immigration is helping balance the labor supply. Supply chains are healing, but there's still more money in the system. And that's basically the summary of what happened yesterday at 10:30 during the FOMC press conference. So as a result of these comments, there was an increased possibility that the Fed will cut rates next year in the first quarter. And as a result of that, we saw acceleration of US equity indices. The Nasdaq rocked higher, the S&P 500, the Dow Jones. Gold also managed to make a comeback, whereas we saw the dollar index weakening quite brilliantly. So from the dollar index, I'll be trying to open the charts now. You can see the big drop that happened last evening, and today seems to be a continuation of the same. So we haven't yet hit support, and this tends to be an attractive way of doing some analysis. So if there's a sharp drop to a certain level, then you expect the market to eventually get to that level. And in this case, for the dollar index, I expect to see 102.348 within the day. And this is just a possibility. It's not a guaranteed outcome. So I expect to see some further downside momentum in the dollar index. So USD JPY, you can see how the dollar was losing to the yen. It was also losing to the pound before this was yesterday in the evening. So a very big spike for pound USD and kept going up today. Then we have Euro USD, Euro making a very strong rally against the dollar, dollar losing to the Canadian dollar, and then gold. Gold made an impressive jump yesterday, and today is looking to continue with that momentum. So this has been the story of the week. So Australian dollar also gaining against the US dollar. Then we have the Nasdaq or the UT 100. So it made an impressive rally all the way up, and today it seems to be pulling back downwards. But then we haven't hit the target yet. Remember, for the Nasdaq, we are looking at an all-time high, a record high for the Nasdaq at a price level of around 16,776. So we are still very close to that goal, and I expect the Nasdaq to complete the journey. So for the Dow Jones, we saw also a very strong momentum yesterday in the upward trajectory, and I expect this to continue. And of course, for the S&P 500, we are also seeing a very strong upwards momentum. So as per yesterday, the Dow Jones was up 10% on the year. The S&P 500 was up 21% on the year, whereas the Nasdaq was up over 50% on the year. So after the announcement, we basically saw some further upside momentum, and I believe now we are even higher than we expected. So from the beginning of the year, and this is basically where the year started, you can see that the Nasdaq is up 53.26%. And this is a record year. We don't usually get this kind of return from US equity indices. But now that investors are currently betting on a potential rate cut by March next year, we could be seeing some further upside happening in these indices. And now, as we speak, this pullback is very much welcome because we are never wanting to buy an asset on a high. You want to wait for a pullback so that you can squeeze in your position at a much better price. So going forward for the day, there's quite a number of things that we will be expecting. And this is majorly from European central banks. So the first central bank to make a decision this morning was the Swiss National Bank at 11:30 a.m., where it decided to hold interest rates steady at 1.75%. And then it had a press conference that started at the same time as this webinar. So I don't have much coverage of what's currently happening, but you can always check it out. So one key way of doing this, you can always go to YouTube, and then you search for SNB Live. So SNB is short for Swiss National Bank, and hopefully we are going to get that live session. If we don't get that, then we look at Jordan. And if that proves to be tough, then the other option is to go into the website itself. Click here and go for latest release. Then you'll find the most recent speeches right here on the website. So the news conference is here and the text is available. You can easily download the text and you'll see what's currently happening. So this was the introductory remarks by the governing board. And then you will be able to go through everything else, ranging from inflation forecast, global economic outlook, the Swiss economic outlook, the monetary policy outlook, ensuring the supply and distribution of cash, the new generation of the central Swiss payment system, among other updates from the central bank. So I'll be sharing this with you. Hopefully, you can share the link. So when you have some time, just kindly go through it. So from the comment section, this is what I'm seeing. Yesterday we cried. Personally, I didn't cry. I was very focused on the live presentation as well as the markets, and I think the response was brilliant. I was expecting the dollar index would finally take some step back and equities would rally as a result of the news. A very good question from Apollo. Does that mean you've been trading for the last 10 years? Congratulations. Then what have you not seen if some of us are shocked by yesterday's price action moves? I think I've seen pretty much everything there is to see in the markets, even though the market always surprises us. I don't think yesterday was as violent as last week on Monday. The price action we saw last week on Monday happening in gold, a movement of over 10,000 pips out of nowhere. It's similar to what happened when the Swiss franc was depegged from the euro, where we saw moves averaging 30,000 points or 30,000 pips within a couple of minutes. So I think for yesterday's price action, it was largely expected, never too exaggerated for the most important event in the economic calendar. So yes, I think the price action movements yesterday were reasonable. Hi, Kalondo Afula. Thank you. for joining the session. I blew my account on Friday yesterday. Apologies, Steven. Normally, what I advise traders is that if you have a risk tolerance level, let's say you have an account with $1,000, and this is an example, and your trade size is normally a maximum of $50 per day. If there's news happening today, just make sure that no matter what happens, you're not going to risk anything more than your risk tolerance level, in this case, that $50. So if something crazy happens and there's a big spike, I know the overall impact is that it excites you. It excites your entire being. So you see a big spike and you expect that the market will form a similar spike in either direction. Whether you are right or wrong doesn't matter. The fact that it has aroused your emotions and you are bound to make a mistake, especially after a big spike in price. So in that case, when you recognize that possibility, if you so decide to continue trading, you always use that as an anchor, the risk tolerance level. So no matter how excited you get, you just decide that I normally risk $50 in my trade per day. So I'm not going to exceed this. So even if I participate and I'm wrong, this is my exit point. So think of it as a train robbery. If you jump on a train and you're planning to rob it, you have two options. One is trying to get what you came for. If you get what you came for, then you jump right out. So if you risked your $50 and you are looking to make $150, $200, and you made that money, then jump right out. If you didn't make that robbery, if it was not successful, you don't stay on the train. You get out real quickly and you count your losses. So in this case, if you happen to risk your $50 and it's gone, just jump out and wait for the next available opportunity. Don't try to force issues, especially during periods of high volatility. These are one of the worst periods that you can easily lose money. So hopefully everyone was able to learn something today, especially for beginners. And of course, apologies, Stephen. Hopefully you'll come back better and stronger. So higher Fed rates are strong dollar, right? Yes. So if Fed rates are to remain higher for longer, then in that case you get a strong dollar. But then from the statement yesterday, it indicated or indications that the Fed is ready to cut interest rates. They're just waiting for the data from the US economy to reflect that. And the market is betting big that the inflation will get back closer to 2% target, and the Fed will go ahead for rate cuts on March next year. So in that case, we see a weakening dollar as a result of a forward-looking market that is expecting rate cuts by March next year. So yes, the markets are always forward-looking. So if they are seeing a potential rate cut, in that case, they go for a weaker dollar, similar to what happened in March 2020. So if you go back to your charts and look at March 2020, the dollar was weakening ahead of the first rate hikes. It was strengthening ahead of the first rate hikes. So yes, today we have a couple of 3 central banks that are doing an interesting decision. And I expect that they will all follow the Fed. So by following the Fed, what do I mean? So from the economic calendar, and I'll try and share my screen here. So we have these 3 central banks. The SNB has already decided to hold rates steady. We haven't been able to capture the SNB press conference. But then the next 2 central banks are happening at 3 p.m. and the ECB at 4:15, where the ECB press conference will be starting later at 4:45 p.m. So remember, for the UK, whenever there is an interest rate decision, we don't have an immediate press conference. So in this case, it's just the decision, the MPC bank rate votes, and then the official bank rate. And later on, we get the Bank of England inflation letter. So I expect that the Bank of England will basically hold rates at the same level. And then during the monetary policy summary, they might mention something around the key indicators that they are watching in the economy, before considering rate cuts. And I think that will be a point of focus, investors trying to understand what the Bank of England is focusing on before making policy decisions. Also, the number of votes will also be important. We need to know how many members are basically voting for rate cuts and how many are voting for holding rates steady. So once we go through this, hopefully we'll get a similar reaction as yesterday, where we could be seeing the pound weakening against other currencies. And on the other hand, the UK equity index, in this case, the FTSE 100, making an impressive rally. So yesterday, we saw that happening, but this was in correlation with the US equities. So you can see the UK FTSE 100 made a very big rally, and today is continuing to move even higher. So in this case, what we are seeing is the market pricing in the potential for the Bank of England holding rates steady and the FTSE flying higher. So investors are not waiting until the announcement at 3 p.m. They are already buying now. So we could be seeing the opposite reaction. So if news are already priced in, then it's buy the rumor, sell the news. So we could be seeing the FTSE 100 accelerate even higher. But then once the news is announced, we see the opposite reaction in the market coming back downwards. So that is a very real possibility for the UK 100 index. And of course, in this case, for pound USD, this strong bullish momentum would be easily reversed if the Bank of England is considering any early rate cuts. And in that case, we could be seeing the market pulling back down to where it started. So be on the lookout for potential reversal of pound USD. So then for the euro, we expect the ECB to hold rates at the current level of 4.50%. And the main forecast for the day will be the monetary policy statement and closely followed by the ECB press conference. So this is bound to bring in some much needed volatility for the euro dollar traders. So in this case, if the ECB hold rates and eventually decides to give a forecast on potential rate cuts next year, then it depends on how aggressive the ECB is in cutting rates. So if indications are showing strong signs of rate cuts in early next year, then in that case, we get to see the euro weakening and European equity indices making a good rally. But then if there's no strong language during the press conference at 4:45 p.m., then in that case, we could be seeing the euro continue to rally against the dollar and European equity indices starting to weaken. So from what we are seeing in the chart, the Euro Stoxx 50 index made a strong rally yesterday, and this was during the FOMC press conference. And then this morning, you can see that the price is making some form of reversal. So in this case, there seems to be some form of normalization effect where the price is erasing the yesterday gains ahead of today's meeting. So for the Euro 50 cash index, it basically means that there's a good possibility that we start on a clean slate. And if the ECB shows signs of cutting rates early next year, then the index is expected to accelerate higher. So remember, this one is trading at an all-time high, and there's a potential we keep seeing the market rocking even new highs, and that is based on whether the ECB is considering rate cuts next year or not. So as for the French 40 index, we are seeing also another all-time high. So a very strong rally here, and the market just attempted to break the area, moved higher, but from what we are seeing here is the market basically pulling back downwards. And the previous high, so try and use the 4-hour chart. So the previous high was right here. So it's basically the current price level, meaning that the previous high has already been broken and the market is pulling back downwards. And from the size and shape of the 4-hour candlesticks, it clearly indicates a strong reversal. So this might as well be a very strong topping pattern for the French 40 index. But then we have to wait until the ECB press conference to see the potential direction of interest rates. So if there's any talk of potential early rate cuts next year, then the index keeps flying higher. However, if the ECB is not looking to cut interest rates, and it doesn't indicate that, if there's potential for another rate hike, then in this case, we see a very strong reversal in this equity index. So the French 40 index might be a very nice target for a reversal if the ECB is looking to continue hiking interest rates. So besides that, there will be more news for the day. Of course, early in the morning, we had the unemployment change or the unemployment rate in Australia, which came in at 3.9%, slightly higher than the previous number and than the expectation. So the employment change, or the number of jobs created in the last 1 month, was 61.5K, and this is a big surprise. It was more than 5 times the forecast, and almost 50% higher than the previous number, indicating that the job market is quite robust or tight within the Australian economy. Well, this is not something that the Reserve Bank of Australia is looking to achieve, but then the hangover from last night's market is still very much prevalent. So what we saw this morning is the Australian dollar continuing to strengthen higher because the Reserve Bank of Australia wants to see a softer job market before rate cuts. So the job market is not getting softer. The economy is still creating stronger jobs. So if rates have to stay higher for longer, then the Australian dollar has to be stronger for longer. So that may explain the continuation of the price action higher. But then right now, as we continue with the London session, we are seeing the market taking a step back, perhaps potentially going for a retest of this area. And I think it has already happened. So the previous high is now acting as support. Nothing has changed fundamentally. So what we are basically seeing here is the market moving back, retesting a previous support. And this was acting as resistance, now it's support. So I expect a continuation of AUDUSD higher. So potentially for a very short-term minded trader, then we just retest today's high. And potentially we could be seeing the market accelerate higher. There's still more room for upside momentum. So besides that, we'll also be looking at retail sales in the US, which is a very strong indicator of consumer purchasing power. So when consumers are strong, they buy more stuff. So retail sales data tends to have an uptick. We'll also be looking at core retail sales and unemployment claims. So for core retail sales, the previous reading was an increase of 0.1%, but in this case, we expect a decrease of negative 0.1%. So we could be seeing a surprise as a result of the large-scale buying that happened on the 3 days that happened in November, this being the one, we had the Thanksgiving Day, two, we had the Black Friday and Cyber Monday. So those 3 days had record purchases in the US. We also had a record number of air travels in the US during that holiday. And this contributes to retail sales. So as a result, we could be seeing some higher number than expected. And this is not very good for the Fed. But then if it comes at weaker than expected, then that will be very good for the Fed, which might imply a continuation of the bullish rally that we saw in the Nasdaq and bearish rally in the dollar. So for core retail, which is the change in the total value of sales at the retail level, excluding automobiles, then when you remove the price, the contribution of automobiles, you get cleaner data, indicating the level of retail sales within the US economy. And of course, in this case, we expect this to drop to by negative 0.1% in November. So also the overall retail sales are expected to drop negative 0.1%, similar to the previous month. But then if there's a big jump, remember, if consumers are powerful and they're buying more stuff, then companies are powerful because they tend to make more sales. And in that case, they perform well when people are buying more goods. So there's a direct correlation between equities and retail sales. The more people buy, the more companies make. So as for unemployment claims, we expect this to slightly drop to 219K from the previous reading of 220K. So this will complement last week's non-farm payrolls job report. We'll also be looking at import prices in the US, which are expected to drop by negative 0.7%. And then that will be it. That will be the end of the day as we look at business inventories and natural gas storage in the US. So as we approach Friday, we don't have much happening. We'll be looking at industrial production in China, and this will be at 5 a.m. Then we'll get the S&P Global Flash Manufacturing and Services PMI for various economies. So we'll be starting quite early. So we'll be getting the Flash Manufacturing and Services PMI for Australia. We'll get that for Japan later in the day. We'll get that for the Eurozone, for the UK, and for the US. So we'll also be getting a speech from Bank of Canada Governor Macklem, and this will be happening at 8:25 p.m. in the evening tomorrow. So that's it on the economic calendar front. And now looking at the charts, I think the most important charts will be as follows. So one, we look at the UK 100 or the FTSE 100. So I expect this continuation of bullish momentum to persist as we approach the news. So remember the news is 3 p.m. So before we get to 3 p.m., the UK 100 could continue running because the market is pricing in potential news that will strengthen the UK 100. So by the time the newbie is buying the asset after the announcement of the news, the market will have already exhausted the upwards momentum and will be moving in the opposite direction. So in this case, it's a very strong candidate for a short selling position after the news at 3 p.m. So for pound USD, it's also a very strong candidate for a reversal. And this is dependent on whether during the rate decision and monetary policy statement, if there's any indications of early rate cuts, then the pound starts weakening. And in this case, the dollar recovers against the pound, basically making a U-turn from yesterday's move. So that's also a potential candidate for momentum today. So this is a possibility. And of course, if the Bank of England is considering continuing with more rate hikes, then a continuation of the same towards a previous high of 1.27326. So as for Euro USD, there was a very strong rally yesterday. So the potential for a complete reversal is there, and this is dependent on whether the ECB projects rate cuts. But then if there's no talk of rate cuts, then in this case, a potential rally for the euro higher than the current price level would drive the pair to 1.09634. So as for USD CAD, continuation of the bearish momentum is happening. And this is coming amid some volatility in oil, where the price action made a recovery yesterday and today is continuing the same, meaning that oil prices are expected to hit the previous high of around $76.784 per barrel. And this was the highest price that we saw on Tuesday. So in this case, it's also similar to the price we saw on Monday. So I expect the price to rally to that level. So it was also some support level back in the 16th of November. So it's quite a relevant level. So there's all indications that there's a likelihood that oil prices continue the rally and eventually get to 76.784. So strong oil prices tend to correlate very well with a strong Canadian dollar. So now we are seeing a strong bearish momentum. Remember, the dollar was weak yesterday as a result of the FOMC press conference. And now the CAD is strong as a result of strong oil prices. So in this case, the bearish momentum seems to be a classical case for a big sell-off in USD CAD. These fundamentals supporting both sides of the trade. So in this case, the drop is expected to accelerate and get to 1.33822. And I think perhaps this is the most potent trade idea for the day. So a continuation of this further downwards towards the 1.33822 price level. So as for gold, we saw a very strong reversal. So remember, last week is when we saw gold prices jumping all the way up and getting to above $21.80 per ounce of gold before erasing the gains immediately and dropping all the way to the levels around 1980. So yesterday we had the big jump that erased quite a number of days losses. So if you count this as 6 days, then on the 7th day, we can see gold rising again and eliminating all the losses. And now we are right where we started on Monday last week. So just before we started Monday last week, price was here. So Friday the previous week, this was the low. So it seems like we had extreme volatility higher, extreme volatility lower, and then the market has recovered. And now we could be seeing a normal, more common recovery in gold, especially after the price action we had yesterday. So some further upside momentum is expected, but then we don't have the full confidence that gold will continue moving higher. So in this case, we just basically monitor the support area and try to understand the direction of the break. So at some point, gold is bound to break off these two trend lines. This is the 5 minutes chart just to bring in some clarity. So if eventually gold breaks either of the two trend lines, then it will give us a direction, and that will be important in determining the direction of the trades. So US equity indices are making a pullback. I'm still very bullish on these ones. For US Tech 100, the Nasdaq and the S&P 500 are all very bullish, but the current price action indicates some pullback. So the pullbacks are very important to bring in a potential entry point. So in this case, I expect the volatility to come in during the New York session. And from there onwards, perhaps we could be seeing a continuation of the same. So key fact is that these assets are very close to all-time highs. So for instance, the UT 100 or US Tech 100, the all-time high is 16,776. So if you look at the current price action level and the all-time high, it's just about 1.07% away from all-time high. So there's no reason to believe that this market is going back before testing a new all-time high. So there's that potential that we continue seeing the bullish momentum. And of course, we have seen other consolidations and how they have ended up. So anytime the Nasdaq has tried to consolidate for a while, it has eventually led to a strong rally in the same direction, upwards. So I expect something similar. So you just monitor the chart in search for potential bullish entry. So when you see evidence of bullish entry, then that might be the signal to go long. So that's it for the day. Thank you very much, guys. I'm trying to see if there is any questions I missed. So from the Jay Powell speech, I gather that the Fed would cut interest rates on these two reasons. The inflation rate is coming down as anticipated, or the borrowing cost is too high, that is stifled. I think the comments he made yesterday is one, inflation coming down, and two, demand, aggregate demand within the US economy. So aggregate demand is basically informed by consumer spending indicators such as retail sales and consumer confidence. So in this case, he's expecting demand to weaken, and once demand weakens, then in that case, he will consider rate cuts. But for now, those are the two key or pertinent indicators. And of course, unemployment rate. They don't want to achieve any significant drop in unemployment rates. Sorry, rise in unemployment rates. So should they find it, that is the later, is it possible we have aggressive jumbo cuts which markets had not anticipated? I think the rate cuts will be gradual. The Fed doesn't want to celebrate a win yet until it's really felt within the US economy. So they want inflation to remain at 2%. They just want, 2% is not a target. It's more of a speed limit. So think of it about it this way. You're driving on a highway and you're overspeeding, but then the highway limit is, let's say, 100 kilometers per hour. So when you brake and you get to 100, you don't want to continue braking. You want to maintain that speed. So you might be pressing gas a little, letting it go for a while, and so on. You want to balance around that 100. So the same case happens to the Fed. It wants to balance around that 2%. So they don't want to cut rates and then cause inflation again. They don't want to cut interest rates back down to zero, and then there is excess money in the system, and then inflation comes back. No. So they want to slightly cut interest rates to allow the economy to get to the 2% target and maintain at that level. So that's why the Fed is projecting interest rates to drop to 4.6% next year, rather than going back to zero. So in this case, that's the key idea. So trying to get one more question answered. So markets are forward-looking. So if there's a potential rate cut, then yields will be the first ones to drop, and they have already dropped to multi-month lows. So in this case, for the 10-year, we are seeing the market fully pricing in at a rate cut. So the 2-year USD swap rate is down by over 20 basis points. Explain why this has disadvantaged it against the FX peers. So clearly, for the 2-year period from now, what we are basically seeing is potential rate cuts. And with rate cuts, it means that new bonds will come with a lower yield, and they will not be as attractive as earlier bonds that were issued this year. So in this case, it creates a lower demand for US treasuries, and as a result, lower demand for the dollar. So that may explain why we are seeing a big sell-off. So what do you think will tame stocks, especially the Dow Jones index, now that rate cuts looms and soft landing is achieved? There must be fraud in the market if 2022 rally. Yes, there is definitely fraud in the market. The valuations, especially for AI stocks, they are crazy high. But then this fraud tends to get complicated, especially when you're looking at the Santa Claus rally. So Santa Claus rally is a common rally that happens between Christmas and New Year. And this is often quite an event, especially when it happens close to an election year. So in this case, I expect some further upside momentum. So from what happened in 2021 rally, when there was quite a lot of fraud in the markets, as we approached the end of the year, investors started taking profits, and that was the basis for a correction that started in January 2022. So if you go back in your charts and look at the S&P 500, the Dow Jones, and the Nasdaq in January 2022, January 2022, we saw a big drop happening after the year was quite bumper. So I expect something similar. So after having a very strong year with the Nasdaq being up over 50%, investors are about to take profits. And if that happens in January, then that might be the basis of some form of pullback in the markets, some form of normalcy, and some fraud getting off the markets. How many assets do you trade at any given time, and what's your favorites? If I remember well, you had advised not to trade more than 4 assets and not more than 5 positions. You analyze all. I tend to analyze a lot of markets, but I focus on the highest premium markets. So I could analyze 10 different markets and only take one. So in terms of the assets on my watch list, there are more than 10 major currency pairs, gold, oil, indices. But then it's not like I trade all of them. I'm always trying to filter if there's a potential position, let's say in the NASDAQ. I want to make sure that before I commit my money in that NASDAQ, there's so many other opportunities in the markets. I want to filter and find out the best. Which opportunity has the lowest risk portfolio and the highest potential reward. So I'm always doing these filters, trying to identify the best of a position. So in terms of how many positions you can have at any given time, if you're a beginner and you've been in the markets for less than 2 years, then always have one trade, just one. Don't go for two, just one. Deal with one trade. Once you have comprehensively dealt with it, move on to the next and so on. But then if you have years of experience in the markets, you can be able to handle 2 or 3 trades. But then if you go to 4, 5 and higher than that, I don't think it makes sense at all. So it really depends on your level of experience and how you can handle different emotions and different movements in the markets. But remember, the markets require that you change your decisions and beliefs all the time and at any given time. So you might be changing your beliefs about a pair, let's say Euro USD, still have another position on USDN, and it can get real complicated in terms of your own mental framework and how you think about the markets. So the more positions you have, the more confused you will be and higher the chances of making mistakes. So if you are a very experienced trader, my advice is still to do one trade at a time. But then if you can manage 2 or 3, then the better for you. So with a $300 account, how many positions can you bet on? Just one. And I would probably suggest 0.01 lot size. So in case of a dovish scenario happens in the UK and Europe, will the dollar be strong? I don't think a dovish scenario strengthens the dollar. Rather, it weakens the currencies themselves. So if it happens to weaken the pound, the Swiss franc, and the euro, then it's time to look for a currency that might be benefiting or gaining against those currencies. And I think we have already identified a candidate. So if these currencies happen to weaken, our candidate anchor asset is the Canadian dollar. So oil prices are currently very strong today. The Canadian dollar is strengthening against the US dollar. So it could as well strengthen against other currencies. So buying the card against other currencies might be the trade of the day. So if these central banks are dovish today and their currencies are weakening, they will be weakening more against the Canadian dollar. I hope that makes sense. Future options expiring this week and how do you think they impact the markets? I haven't checked that yet. When is the best time to trade in Kenya? Is it 12 noon or 12 midnight during the London USA match? As I've already said, when it comes to trading, there's no best time. The best time trading last week on Monday was just after midnight. So the best time for trading yesterday was just after the FOMC press conference or during the press conference. And the best time today might be different. So what we trade is the price, it's never the time. So whenever you're trading the markets, you want to see a big difference in price between your entry and exit price. And that difference can happen at any given time. So the idea is to look for good setups and wait for them to play out and give you a signal to enter, rather than focusing on time periods. Time periods will basically lead you astray. Focus on price action, do your analysis, identify potential entry points, and then be patient, wait for the market to give you the opportunity. And the market can give you opportunity at any time, at midnight, midday, or at any other time of the day. In relation to the question on our trades, what are your favorite trading times? I don't have favorite trading times. I have more of favorite setups. And favorite setups for me are when markets are at extreme levels or breaking to newer highs or newer lows. So when I see extreme price levels, they excite me because they often represent more volatility and potential to make a good return from a small investment. So that's it for the day. I know I was late to start the session, but I think this is more than enough compensation, having done a full hour compared to the usual 30 minutes that we do every day. So in this case, thank you very much, guys. Thank you for joining the session. Thank you for your time. And I hope to see you later in the day at 8 p.m. So remember, today is Thursday. So at 8 p.m., we normally get an extra session. And at the same time, the newest episode of the Bullish Banter podcast is out. So make sure to check it out and share your comments, share this with your friends. Make sure that they're also hooked on the Bullish Banter podcast. Don't be just the only trader who is benefiting from this without sharing with others. Remember, in the markets, if you gain and another person gains, it doesn't take a toll on you. There's enough pips for everyone. So thank you, guys. See you later at 8 p.m.